Welcome to Passport to Wealth, the podcast for U.S. expats ready to take charge of their finances while living abroad. I'm your host, Arielle Tucker, a certified financial planner, enrolled agent, and fellow expat, here to help you navigate the complexities of cross-border life with clarity and confidence. Hi, welcome back to Passport to Wealth. I'm your host, Arielle Tucker, certified financial planner and IRS enrolled agent, and I am joined once again for the third time with Emily Haines, CPA. She runs a fabulous international tax practice. She's currently based in Seattle, but splits her time in Berlin as well, which is where we always get to meet up in person every summer, which is always a highlight for me. Emily, welcome back again to Passport to Wealth. Today, we are going to be running through some year-end financial planning and tax strategies for U.S. expats. This was most recently in our newsletter. So we have a newsletter that goes out to over 1,400 current and aspiring U.S. expats. So if you want to be part of that, we'll link our newsletter below. But we're going to run through the 9 kind of planning tips and checklists that we put out. And I'm happy to have your insights today as well.
Thanks for having me.
Okay, so starting strong with number 1, our first tip was optimizing your tax strategy, comparing the foreign earned income exclusion versus the foreign tax credit. And so we always tell people to look at this sometimes multiple times a year, right? It's, you want to think about it right now as we head to the end of year. Maybe your situation has changed significantly and you're thinking, okay, am I still going to take that foreign earned income exclusion, which I believe is $130,000 for 2025. Is that correct?
Yep. I think that's where it was adjusted. Though with the dollar exchange rates with the dollar, that's going to be it'll be a lower number of euros.
Yes. And that is a great point for people who are living in euros and Swiss francs. All of a sudden, you have not felt like you've earned more money, but because everything is going to get translated back into dollars, you're going to suddenly say, like on paper, it's going to look like you've made, anywhere between 10 and 15% more this year than in previous years. So that has the potential to push you up into another U.S. tax bracket, maybe subject you to net investment income tax, maybe start to phase you out of some other credits. So it's definitely going to be a year to just understand you did nothing, the dollar just weakened.
Right. And in looking at the foreign earned income exclusion versus the foreign tax credits, those foreign tax credits are also going to be inflated because they're in euros, or whatever currency that you're in, and they're going to be moved to translated to dollars at average rates for 2024, which is going to be different than in previous years.
Yep, that's a great point as well. And so we're going to see this exaggerated impact depending on if you're in a high tax country or a low tax country, right?
Mm-hmm.
So we're going to see it's either going to be a much higher tax bill because we have less, foreign tax credits. We're in a low tax country, or we're suddenly just going to have an excess and a buildup of foreign tax credits that will then continue to carry over if we stay in these high tax countries. And so they just kind of carry over for 10 years. So that's tip number 1. We've got a lot of tips to get through, so I'm going to keep moving fast today. Number 2, max out retirement contributions. What are your thoughts here on IRA contributions?
Yeah, I think the Roth is tricky. We have a lot of people who will contribute to a Roth, and you really want to check your eligibility. There's phase outs of your income limit. And with the exchange rate the way they are, you may not know until the IRS publishes their average rates for the year, which will be ideally in February, but who knows what the shutdown fallout. You don't know right now whether your income is going to be above those phase out limits. And you can make a contribution up until April 15th. And so it might be good to wait until you can calculate your US dollar income to make those contributions for 2024.
Yeah, I completely agree. Roths are always a little bit tricky. A lot of countries don't recognize Roth. You have to be prepared. Am I going to be subject to double taxation if I put a Roth? Because this whole concept of a Roth account is very unique. You put money away and it grows tax-free and you pull it out tax-free. There's not a lot of other countries that have an equivalent account like that. Much more common is that traditional or rollover IRA, right? We're very familiar with those types of accounts. You put money money in, it's tax deferred. Maybe you can build up a basis of that, but you're paying tax on the way out, if not on the entire contributions plus the growth, at least just on that growth. So that's an important distinction to understand between the two different accounts. And I agree is if you are unsure of what to do, the best plan of attack for an IRA contribution is to try to get ahead. I know that's always hard in the expat tax space. Try to get ahead on, your filing for 2025 and see if you can run a really good faith estimate before the contribution for 2025 is due on April 15th, 2026. So you do have a little bit extra time to make that contribution. If your situation changes and you realize I still have a little bit of extra time, it doesn't end on December 31st. Next tip, review foreign pensions and local retirement accounts.
Yeah, foreign pensions are tricky, and you can run into a lot of tax issues in the U.S. The U.S. isn't always, just like the foreign countries aren't recognizing a Roth, the U.S. may not recognize what's happening in a foreign retirement account. And so sometimes you think that you're doing all the right things and saving for retirements, and then you're going to be slammed with punitive tax when you get those distributions later, or high compliance costs on an annual basis.
Absolutely, Emily. I mean, this is something that is country to country specific that we're talking about, and also plan to plan. So country to country and then plan to plan. And I know that this is stuff that we've emailed. Hey, can you review this plan? We're thinking about this plan. How does this one look? Is it going to be cause PFICs? We've talked about PFICs on the podcast before. Mm-hmm. If you're not sure what I'm talking about, go back, look up the PFIC episode. We've written about those. So it's really important that you understand how is the U.S. going to see this foreign plan? Because logically, right? And again, nothing about U.S. tax is logical at this point. Logically, you're just trying to do the best for yourself by saving for retirement and working within the system in the country that you're a resident of. Unfortunately, these systems do not align perfectly. And this is where we see people who have tried so hard to do the right thing, and then they end up in these missteps. So just want to flag that if you're listening to this episode and you're like, oh man, what did I get myself into? This is where you want to have an accountant and you want to be able to just go to them. You don't need me. You go to your accountant and say, what about this plan? How are you going to report this plan on my tax return? That's a really important thing, because I've seen hundreds of different tax preparers, and there's sometimes a level of interpretation, right? How do they view the plan, and then how do they report the plan? So it's something that I say, whoever's signing your tax return really needs to be that person who's signing off on how that's going to get reported. This is also going to tip number 4. This is also a really good time because we're thinking about all these different potential reporting requirements. It's also a good time to just kind of check in. Did I have any new bank accounts this year, or any other type of foreign accounts, right? You're going to have those FBAR filing. That FBAR filing is separate from your tax filing that reports your foreign bank accounts. That's separate. And you may also trigger additional FATCA reporting. The FATCA is part of your tax filing, but those are different forms. So again, especially with the stronger foreign currency, with the weakening dollar, you may not have hit those FATCA reporting thresholds. And all of a sudden this year, because of, the weakening dollar, all of a sudden you're going to have those additional reporting requirements.
Right. And those, for those thresholds for the bank accounts for the foreign assets, those are translated at the year-end exchange rate. So that's December 31st. And so could be anything.
That's true. We don't know what the rates are yet. Exactly. Yes.
And those come out maybe a week or two after year-end on the Treasury Department website. I think beginning of January is a great time to go ahead and file FBARs and just take it off the list when things are fresh. And yeah, getting it out of the way.
I completely agree. And I know you're an accountant and I know people pay you to do this. So unpopular opinion, people who come to me and they say, oh my God, my accounting fees are so high. What can I do to cut my accounting fees? The first thing I tell them is learn how to prepare your FBAR. That is relatively simple. It hasn't really changed year to year. If you have a list of all your accounts, it's something that you can, prepare fairly easily. So try to do that, and maybe do it for 1 year, have your accountant pay your accountant to review it, make sure it's correct. And then you have a template and you can do it yourself going forward. And you've saved yourself a couple $100 every year for compliance.
I agree with that. We support our clients doing it themselves. I think if you're living as an expat, it is just a great skill to put in your expat skill toolbox.
Yep. Okay, number 5, preparing for U.S. tax form delivery. This is important because not all companies provide digital files. And if you're working with financial institutions in the US and you're still using your friend, your neighbor, your parents' address, or tax forms might end up at their house. So make sure you log into any financial institution that you're doing business with. Make sure that you're signed up for electronic delivery, because all of those forms are generally due by the end of January. Sometimes we have forms rolling in through, May. If you have K1s, you might not get those till the fall. But in general, a lot of forms are going to be coming out in January and February, and you don't want to have a lost 1099 be holding up your tax filing.
Yeah, I think when you move abroad, there can be a lot of chaos, and sometimes there may be that one bank account, that one investment account maybe doesn't have much, and knowing where to expect this income from is half the struggle.
Because here's why this is important, right? If you forget a 1099, you forget something, and then you file your tax return, and then the IRS says, we received information that you had income from this other source that you didn't prepare. Now we're in this, you're abroad, you're going to have to wait weeks or months to receive this notice from the IRS. You're going to get this notice. Oh my God, the IRS is mailing me a letter and they're telling me I owe more money, and you're panicking. And then you have to go back to your accountant. Oh, we missed this. Okay, now we have to, file an amendment or agree to these additional taxes. It becomes a whole thing. And it's just like, not worth it. And it probably isn't for very much money. So it's like, we just want to try to have a complete first best filing and move on with our lives. Okay. So another thing that we are talking to our clients about right now is harvesting capital gains or losses. And I say this with caution, right? Because if you are living in a country like most of Europe, right, whatever you're doing on the US side is likely going to have tax implications in your local country. And so what you need to do is you need to be kind of comparing, if I sell this on the US side, what is the tax implication going to be in my country of residence? And it's been really interesting to do this review as we head into the end of the year, and we're doing these tax comparisons. And sometimes we're seeing losses in euros and gains on the US side. Because if you've been paying attention to the market in the US, it's been a fabulous year from a US perspective. But again, the dollar has weakened against the euro, and so we might not see those same gains. So you kind of have to be thinking about both country tax implications and not just what's happening on the U.S. side.
Yeah, I think we're going to see this. It's very likely with the exchange rate situation that if you have an investment account in euros, you can make losses or no gains, or have it be neutral, and you would make a gain just on the currency in the US dollar. And then you wouldn't have paid tax in local currency because there's a loss or no gain, but you may owe tax in US dollars.
Okay, but can we, if we have resources correctly on the Form 1116, can we use credits from previous years, right, to offset it? So I think that's like a strategic planning opportunity, because maybe we are taking some gains on the US side, even if we don't necessarily have gains on the euro side, but we're starting to use down some of those foreign tax credits. So it could be like an interesting opportunity. But again, that might not work. If you just moved to a country, you don't have a buildup of foreign tax credits, it's not going to be an interesting planning opportunity for you. So again, this is something you need to be looking at on both sides.
Yeah, and a big concern when we're filing taxes, we're always trying to, no matter what the situation is this year, we're always trying to maximize foreign tax credits so that we have those for the future, because it really smooths a lot of future issues. And I think some people I think any individual can possibly do their US tax return when they're abroad and zero out their income on an annual basis. But the expertise of hiring someone is really like forward looking in that we're better able to set people up for the future by thinking, okay, what can we do this year to make sure we've maximized all of the foreign tax credits that we can, so that in future years there's more buffer to work with should there be currency issues, should there be whatever's happening.
Yeah, and when I'm saying the form 1116, that's for the that's the foreign tax credit form. So that's what I'm talking about. If you're like, what is this woman talking about? We're talking about foreign tax credits. And going back to kind of the beginning of the conversation is, we talked a little about foreign earned income exclusion versus foreign tax credits. Those things interact in different ways. If you have a good tax software, you can kind of play around and see the different impacts of that. But again, I do like foreign tax credits because they give a flexibility where the foreign earned income exclusion, it's a use it or lose it. That works really well in low tax countries, but if we're talking about high tax countries, I think the foreign tax credits give a lot of flexibility. And that's where kind of the fun planning opportunities kind of come in for you and I. Okay. The next thing we're going to talk about is estate planning and gifting thresholds. And this is another complex topic because it really depends where you are currently resident. So from a U.S. perspective, the annual gift exclusion is $19,000 per person. So you can gift anyone you want from a U.S. perspective, $19,000 per person, and you are not going to trigger any additional filing requirements. And so let's say you've got two parents who are based in the U.S. and they each want to give you $19,000. Now you can receive $38,000 and no one has to file a tax return. And if you're married, we double that again. If you've got kids, we just keep adding. So it gives a lot of flexibility to families to gift money very efficiently, very quickly without these additional tax reporting. Now, the thing that you have to be really careful about is, again, every country has different considerations for gifting. And so if you're in Germany, those thresholds are significantly lower. Most of Europe, the thresholds are significantly lower. So if the family has already been doing a lot of significant annual gifting and now they want to just do $19,000 more, well, that may trigger a local gift tax return or potentially local tax, even if that money is coming from abroad. And even if you're not a citizen of that country, you're just a resident of that country, there may be an additional filing. So it's important wherever you are currently based that you understand what are the local considerations and how do those layer into the U.S. tax considerations. Because I mentioned estate planning on the U.S. side. I mean, it's like $13.41 million, right? Mm. Less than 1% of U.S. Citizens have any federal estate tax exposure, right? And you can like plan that away at this point. So it's really becomes the inheritance tax issues are much more especially on the European side.
Yeah, I would second that. I think a lot of people are thinking their first consideration is the US, but it really needs to be the local country where you're resident. These are really complex issues and thresholds can be very low. So it's definitely a place to start with your local tax advisor.
Yeah, absolutely. Okay, reviewing your local currency exposure and cash reserves. This is point number 8 on our list. So again, we've talked a lot about how the dollar has weakened. And when we talk about your emergency fund, when we talk about any funds that you're going to need in the short term, so anywhere between 1 and 3 years, or if you've got a really large purchase, right, we're saving for that, 2 million franc home on, in Zurich, then you really need to be building up those reserves in local currency. You don't want to be subjecting that to additional currency risk, right? We've different types of risks that we're always trying to manage. Market risk is one of them. Is that money in the market? Is it not? But then currency risk, that's a huge one. And especially for this year, we've seen that really play out. And so really think through, am I retired? Well, then in that case, you might want to have a year or more of local currency, especially if you're receiving a U.S. pension or a U.S. dollar denominated Social Security and all of your funds are in US dollars, you really want to make sure you've got those really healthy reserves in your local currency. So if there's a point where the dollar drops even more, you don't feel like you've had to, you're forced to exchange. You can kind of plan it out and be really intentional with that. Okay, and then last point number 9, going back to kind of thinking about capital gains, capital losses, rebalancing your investment portfolio, right? And so that is something that you should be looking at minimum if you're self-managing at least once a year. If you haven't looked at it already, this is a good time to just get it on the calendar to make sure, do I have the appropriate amount of risk, right? Do I want to increase my international exposure? That's been a really hot topic this year. For years, international dragged against the US, and wow, the winner this year has been international. So really thinking through, where am I living? How do I add in more currency exposure into my portfolio, even if that is, in a USD denominated portfolio, you can still start to build up assets that are held in other currencies, right? So there's a reporting currency, so that might be in US dollars, but then there's the underlying currency of the asset. And that is really important and we're always going to see from a US dollar perspective, you might see that will, perform better because of the currency fluctuation in years like this. So just another kind of consideration. Okay, those were my 9 kind of points. Anything else to add, Emily? What am I missing for end of year?
I think just looking forward at next year, I'm curious just from a compliance standpoint how the IRS workforce has been cut down a lot. And there's new tax rules that as far as I've seen, are not super affecting international a great amount. I think there's still some finalizing of details there. I think, the filing season next year could be a little interesting.
Yeah,
Um,
it will be interesting to see how everything plays out on the IRS side, because we were shut down for 43 days, right?
mhm.
And so now, and then the workforce has been cut by 50% since the beginning of the year, I think.
Yeah, and the shutdown happened. This is key time for getting filing going, working on the e-file system, because they have
Yeah.
to do annual updates to the e-file system.
And we're
Yeah.
going to try to get this episode out in early December. We're recording it the day before Thanksgiving right now. But I think that's another important point. So if you are still in the throes of filing your 2024 tax return, I know some of you are, no shame. It's just important to note that the e-file system does shut down. And it's generally shut down from the end of November through mid to end of January. So if you have to file a tax return during that time, you have to mail it in. Or depending on if you owe or what your filing situation is, you might just be better paying the IRS online and then waiting for the e-file system to reopen and then filing your tax return at that time. So
Yeah.
kind of depends on the situation, but I don't know if you have any thoughts there.
Yeah, one nice thing from the shutdown is that they extended their e-file shutdown deadline to it's quite late in December. So there's still time to
Oh,
e-file
okay.
your taxes this year.
Okay, so you could still squeeze in because you're normally it's shut down. Okay, so I'm glad because I'm not filing tax returns, so I'm glad you're here to get us. So that will be really interesting, because if they're keeping this open till the end of December, how much time are they going to need with this shortened, less staff to get things moving again?
Yeah. So I think next year is going to be another patience with the IRS. Get your tax return in sometime at not the highest highest point, just comfortably in May.
Agree with all of those points. Emily, it is always so good to have you on and talk tax with you. Thank you for joining us for this. We'll try to get this out for everyone as soon as possible, so we can make sure they have a few weeks to think about end of year planning opportunities if they're not on our newsletter. And if you're not on the newsletter, we'll be sure to include a link to get you on there. We'll see you again soon.
Yeah, thanks for having me.
Okay, bye. The content shared in this podcast is intended for informational and entertainment purposes only and should not be considered financial, tax, or legal advice. We encourage you to consult with a qualified financial advisor, tax professional, or other licensed expert before making any decisions based on the topics discussed. Everyone's financial situation is unique, and personalized guidance from a trusted professional is the best way to ensure your choices align with your individual goals and circumstances.